Hello and welcome, everyone. Thank you for joining us today. I am very pleased to introduce Christian Catalini, Chief Economist and co-creator of Diem at the Diem Association for this DMI livestream. Christian, the last time we spoke was post-launch of the first Libra white paper, something that both kickstarted the conversation of digital currency using blockchain by the private sector and also catalyzing new conversations in the public sector on central bank digital currencies. Today, Diem's plans look very different with the single currency stablecoins, the system governance, the Diem's reserve structure, and the method of issuing and burning of tokens. We have also seen more information on how the association could prove that all stablecoins in the circulation are backed by corresponding assets. So data on the composition of the reserves and the market value of these assets will be available live. Diem also seems to be beefing up regulation. So it's outlined a number of compliance measures, from requiring all permissioned members of the blockchain network to conduct due diligence to the method through which they supply coins and how it's managed. So Diem will also allow its blockchain to be publicly verifiable, giving audit powers to all. Before I hand over to you, Christian, who will present the various aspects of the economics of Diem ahead of its launch this year, a quick note for our audience, please do send your questions via the Slido link in the chat box. We hope to have a short Q&A after the presentation. Thank you. Over to you, Christian.
Thank you. It's a great pleasure to be here with you today and to discuss kind of the design of Diem with all of you. As you highlighted in your introductory remarks, the project has matured quite a lot, and part of that is really the result of the invaluable conversations that we had with a number of regulators across the globe in response to the first version of the white paper, but also the kind of upgraded and updated second version. We had to make a number of changes to the original concept, and we think that this really drives towards stronger consumer protections, better frameworks for fighting financial crime on the network, and also for laying out what the governance of Diem would look like in a world where central banks are progressively approaching the concept of CBDCs at an increasingly rapid pace. So we really look forward to those conversations and to being an active contributor, not only from kind of the private sector perspective, but also at the interface between public and private. I will get back to this throughout the presentation, but the first part will really give you an overview of where we are today, what the design is, and why do we need a new type of stablecoin? What role does it serve? And why do we need a network that can really make payments more efficient, faster, and more competitive at a global scale? At a high level, we've often highlighted the need when it comes to cross-border payments. The average cost of sending money across borders is still extremely high. World Bank data, approximately 7%, but even smart remittance senders pay on average 4.2% to send money abroad. And that does not include, the cost of delays, time spent, for the money to be in transit, and even the last mile frictions that many of the remittance senders and receivers incur on a daily basis. That's one example, but I think there's an analog even in developed countries when it comes to small businesses and merchants trying to accept payments. I think if anything, the pandemic has highlighted some of the friction in current payment systems, and even when governments are trying to really support and stimulate the economy back, how long it can take to get cash or essentially a stimulus check in the hands of a citizen. So I think there's a lot of work to be done here. And our goal is really to contribute to that progress. But at a high level, kind of going back to the basics of the design of Diem, we think that blockchain technology can add value in this space, and digital assets in general can add value to payments because they can make them faster, more efficient, and more interoperable. Interoperability, as you'll see, it's really one of the key tenets of the network, and one that we think will drive not only innovation, but also reduction in cost. To economists in general, the technology is fascinating, not only because it lowers the cost of verifying digital information, but also because it allows you to bootstrap and operate a digital payment system like Diem without assigning control to kind of a single intermediary. And we think that those good properties will pay off, especially in the long run. Now, when it comes to designing a stablecoin for payments, so for essentially serving consumers and businesses, there were a number of changes that we had to do along the way. And part of this is really the result of the feedback from the G7 stablecoin report, the FSB stablecoin group, and other more recent documents like the Presidential Working Group in the United States. If you want to use digital assets for something that will touch retail consumers, you have to really think about consumer protection and managing and fighting financial crime throughout the system. And so there's a number of dimensions, as you were highlighting at the beginning, that are different about Diem relative to any stablecoin that's been deployed to date. We will be starting with single currency stablecoins. Think about a Diem dollar. But also we have a comprehensive compliance framework that will really ensure that the network can provide not only fast and cheap, efficient payments, but also safe ones and kind of prevent bad actors from abusing the system. As some of you may remember, in the original white paper, we had this concept of transitioning the network to permissionless. That presented a number of challenges, from a health and integrity and safety of the network at scale. And so now we kind of have a novel approach that really brings back some of the good economic properties of networks that are permissionless, but within what we think is actually quite a novel approach. And last, a Diem reserve, which, as I will get back to, it's kind of, we see it as an intermediate step towards integration with CBDCs. But in that phase, it needs to be designed to really address all sort of market conditions. And I think the G7 stablecoin report and the FSB work really highlighted what are the kind of concerns that we needed to provide good answers for. And on that, we really borrowed from more traditional financial systems, and in part kind of applying the Basel III framework to the capital requirements of the Diem reserve to ensure that consumers and anyone interacting with the network will have strong guarantees of that one-for-one kind of ability to convert coins against fiat at any point in time. At a high level, there are at least three key economic objectives here. The first one is like building trust in this really efficient payment token and coin. The second one, ensuring that the resulting market for payments and financial services is extremely competitive. Again, as I mentioned, interoperability is kind of the starting point. It allows a small player to be fully interoperable with a larger one so that users can really choose their providers based on their preferences, whether these are preferences in terms of cost, privacy, or any other dimension they may care about. And last, we do need a design that really ensures robust governance. If you go back to the issue of financial crime, we need to ensure that the governance of the association and also of the regulated entity, Diem networks, is robust to a future evolution, and that some of the provisions that we're introducing today cannot be kind of challenged or removed later. So let me go kind of in the first one really briefly, again, just to give you kind of an overview of where we are. As you may have seen in white paper 2, there's a description of two types of Diem coins. I'm actually going to focus on the left side, so the single currency stable coins. That's where we're starting, and we plan to kind of potentially introduce additional single currency stable coins over time. The starting point will be a Diem dollar. We still have a concept of a multi-currency coin, although it's not part of kind of the initial plan. And we also did some major changes to how that multi-currency coin will be defined. But the basic intuition is that these single currency stable coins are really the building blocks of the network. And over time, we see collaboration with the public sector as a way to support more and more of these single currency stable coins, and eventually also phase out the management of the reserve, which you can think of, almost like retrofitting the new, faster digital rails to the traditional ones, and kind of be able to support use cases on top of CBDCs. I think we're seeing really rapid progress, and maybe some of this was also in part of reaction to our first white paper, but it's extremely exciting to us to see that the public sector is paying so much attention in improving what we think should be the backbone of any payment and settlement layer in every country. And where we're hoping to play a role is as a payment network on top of these public rails. that can enable all sort of new use cases and really good applications, both for consumers and for merchants, small businesses, and payment service providers, and the like. Now, when you think about what's under the hood in each one of the single currency stablecoin, we needed extremely strong protections. And the basic intuition is that, at least to date, stablecoins have not been held to the standards of traditional financial institutions. By us pursuing a payment system license application in Switzerland with FINMA, we're actually going through very similar motions to those that a new institution kind of forming a bank would have to go through. Now, of course, there are some differences. For example, the Diem reserve will not engage in any sort of maturity transformation, but at the same time, it's extremely important that beyond the one-for-one backing, it also owes additional capital requirements and buffers to account for, all sort of different types of losses that could occur. Now, in our system, credit risk is going to be extremely limited. Think about a DM dollar, the counterparty would be the US government, but market risk. So given that the reserve will be predominantly 90 days or less US treasuries, if you have an interest rate shock, you need to be able to absorb that and still allow for kind of at par redemptions. Similarly, you could imagine a moment in time where there's loss of confidence, there's a run on the reserve. We need to ensure that we can address that liquidity risk, absorb losses from kind of fire sales of some of these treasuries at scale, and still kind of guarantee confidence in the payment network and the instrument. There's a range, of course, as you can imagine, like any other payment network, of operational risk. And so all of these combined really landed us on a framework that, again, follows really closely the Basel III one that, on top of the one-to-one backing, adds additional cushions that we will have to maintain at all time. I mean, for those of you that are in banking and in financial services, this may seem obvious, but again, today, this is not the state of the technology in digital assets. And so in a sense, we'll be breaking new ground by bridging some of these best practices into the digital asset space. Just to give you a little bit more detail, of course, this is very much driven by our lead regulator, FINMA, but these capital requirements and buffers will have to kind of grow, not only if the reserve were to grow in scale, but also if the compositional risk across all of our assets were to change. So very traditional pillar one, pillar two, one that we, of course, have to maintain at all times, and one that is meant to kind of absorb temporary losses. How are we going to fund these? Of course, through the initial injection of capital from investors, and of course the revenues that the system may generate at scale through traditional transaction fees. On top of this, we think that it's extremely important to bring a very high level of transparency. So the public should be able to regularly check on a daily basis what is the composition of the reserve, and of course, there's also going to be audits by independent auditors that will confirm that on a frequent schedule. This is important, of course, to maintain confidence and also to show that essentially, the system is performing as designed and there are no hidden risks. At the high level, it's really important to think about this phase where we're managing, mostly treasuries and cash with global custodians to provide these digital coins as a temporary one. The goal is not to keep operating such a reserve forever, and we see that one of the potential paths, you could imagine, a country, for example, experimenting with a wholesale CBDC and maybe allowing the banks to hold that CBDC. In the same way we have a relationship today with banks, we might transform that relationship and essentially hold through our partner banks, this digital asset developed by the public sector. Again, I think there's still a fair degree of experimentation and uncertainty on how the public sector in different countries may approach the deployment of a CBDC. And in a sense, we want to be able to support different types of approaches and enable fast, cheap, efficient payments, and eventually also financial applications on top of it, whatever that design might be. Now, when it comes to the second dimension of trust, this relates to kind of the network protocol economics, and probably the most important dimension that we focused on from the very beginning was We want a protocol that's going to be really encouraging competition. Now, when you look at consensus protocols to date, there's some really good technical ideas, and I think there's been quite some progress in terms of thinking through the crypto economics and kind of the market structure that results from some of these protocols. But at a high level, we have yet to see a protocol that does not lead to some degree of concentration. And so, from the very beginning, we kind of looked very closely at things like proof of work, proof of stake, and their more recent evolutions. And one of the things that we found extremely challenging across all of these was that the resulting market always seemed to lead to some type of actor controlling a disproportionate share of influence over such a system. Just to start, for example, with proof of work and why we did not pursue proof of work. Well, in proof of work, for those of you familiar with the concept of mining, you need wasteful computation to secure the network. And that can be a very interesting approach in a context where you do not have institutions and you cannot rely really on the rule of law for setting up contracts. But as a result, the only way you can really incentivize network participants to make new investments and upgrade the network is towards wasteful computation. It turns out that if all you're rewarding from a processing and validator side is this kind of solving our cryptographic puzzles, that's where you're seeing most of the improvements. As a result, you're also seeing concentration. Insofar as there's economies of scale in proof of work or in developing technology or IP related to mining activity, you often end up in a world where mining has a disproportionate share of influence over that network, and really the only way for participants like consumers or wallets or merchants to counterbalance that market power is through a fork, which, as you can imagine, is a pretty drastic governance shift. Additionally, proof of work was ruled out also because of its impact on the environment. We thought that we could come up with kind of a different approach, given our purpose of really serving retail consumers, merchants, and kind of going in the space of payments. And so Diem is kind of a hybrid, for the economist following along. It really relies on relational contracts. And when you think about it, this is where participation by reputable institutions that are essentially coming in and building out the network in the phase where it's kind of nascent and most vulnerable, it's extremely important. We have a few papers for those of you kind of interested in some of the economics behind it. But at a very high level, this is where the Diem Association members are extremely important. They're needed to kind of see the ecosystem in terms of use cases, in terms of like applications. And they're also going to be the ones operating validator nodes. I'll get back to that in a second, and defend kind of the structure and safety of the payment system. Now, at a very high level, and this relates to competition, Diem is designed like an open technology standard of the internet. And the basic intuition that it should always allow incumbents, startups, different types of players to play on a leveling playing field. And interoperability is going to be really important to achieve part of that. But in general, we think that ensuring that there are low switching costs between different wallets, between different payment service providers, between different exchanges will ensure that not only consumers will experience lower cost and more innovation, but also that there are lower barriers to entry for new types of players into this system. I will get back to kind of the process for kind of expanding the membership, but at a high level, we think interoperability, the same way it was so beneficial for the internet, is going to drive lower prices. And I think we've seen some of these in countries like India that have made massive improvements in having really shared infrastructure, but also in enabling new types of use cases that I think today are stifled by the lack of interoperability. Last is kind of the trust in the governance and the evolution of this network. And we think this one is particularly important in the short run to ensure that people who would want to join and build on a system, whether they're a member or not, and in the long run to ensure that the system can stay innovative, competitive, and can keep kind of renewing itself over the years. So when you think about it, an independent and strong association is really the starting point to encourage participation and adoption. Without that, and without distributed governance, what you often land on is kind of walled garden solutions where everybody keeps fragmenting payments and financial applications further and not operating on the same rails. And so on this, actually, I would say Diem is more similar to standard setting organization, again, like some of the ones that are supporting the important standards that power the internet today. And the founding members are really just needed at the start to drive utility adoption, secure the network, as I was mentioning, under our BFT consensus algorithm. And for those of you that are familiar with proof of stake system, in a sense, solve the nothing at stake problem that some of these systems would face in its infancy. So we hope that this will, again, encourage a number of participants to come and build on the network and really interoperate with each other and compete for the market rather than before. At a high level, the association is also extremely important to really avoid the tragedy of the commons. If you think about here, these are shared rails, and so investment in safety, security, and upgrades and R&D, everybody benefits from them. But of course, there's a classic externality in how much they're able to appropriate. As you know, in the original white paper, we talked about transitioning the network to permissionless. What we realized in conversations with regulators, and especially if you think about the payment use case, is that there's no way today to reconcile that approach with some of the requirements when it comes to consumer protection and fighting financial crime. At the same time, we think that some of the economic properties of permissionless networks, namely the fact that everybody can kind of build and compete on very equal terms, are really important. And so we're developing what we're calling kind of an open, transparent, and competitive market for network services and governance on Diem that we think will replicate these good properties without running into some of the issues that regulators have pointed out about the permissionless approach. At a very high level, we're relying on BFT. BFT consensus protocols have a very long history of multiple decades. They're not new. And they have some good properties, like they can enable higher transaction throughput, lower latency. They don't require wasteful computation and mining. We can clearly describe transaction finality, which is something that, when you take, for example, a PFMI approach is really important. And in general, they're very resilient. So Diem could lose, up to a third of the network. These nodes could be compromised or fail and keep operating without issues. Now, from an economics perspective, there's one key challenge in BFT systems is that you're essentially trusting the validators. And so the quality and incentives of these participants is really important. And that's where, to achieve incentive alignment and to really ensure that we can bootstrap and defend the network in the early stages, the founding members are extremely important. So when you think about kind of the design here, it's kind of a hybrid between some of these approaches that we're seeing in around cryptocurrencies and other blockchains, and more traditional systems that really require the reputation of the participants to be kind of a key component of why the network is protected at any point in time. That said, this is just a starting point, and we think that competition is actually a key prerequisite for achieving these goals that I was describing around interoperability, innovation, and really competition at many different levels. I would say there's at least 3 levels of competition that we want to encourage. The first one is, of course, competition for payments and financial services on top of the networks. So we think that members and non-members should compete on a level playing field in providing services to business and consumers. When you think about the infrastructure, it's going to be also important to drive competition in those services so that we can over time scale the capability of the network and upgrade it in a way where a player that is really skilled at operating safely, say a piece of the network in the cloud, can kind of play a role. The more complex one is really kind of scaling competition in the governance and evolution of the project. And this is where, in a sense, we're taking a page from market design and other approaches from other systems. The idea is over time to use kind of an auction-like approach to kind of expand membership, to renew membership, and really to ensure that at any point in time, the members that are driving growth, that are driving applications, and that are making meaningful investment in protecting and defending the network are the ones that have a voice in the governance. And of course, part of that is also reflecting what consumers may choose when they select one service provider or another over time. So to conclude, I think there are three key questions when thinking about the journey so far with Diem. And the first one is like, why build a new type of stablecoin? The second one is like, what are kind of the risks that we've been focused on, which is actually closely related to the first question. And last, how can we really support public sector innovation in this space? We think we can play a useful role in really supporting public sector experiments in this new area, and really bring kind of a comprehensive approach to some of the challenges and risks that the public sector has been highlighting. So let me start with the first one. Why do we need yet another stablecoin or a new approach to building a stablecoin? Well, the first reason is essentially because although we think that blockchain and digital assets have tremendous potential, a lot of the benefits of the technology have not been brought all the way to payments, to consumers, and to merchants. We do not have faster rails, efficient rails, and especially interoperable ones that can allow consumers and businesses to transact, ideally on a global scale, at almost no cost. And that's definitely the goal here. But of course, this needs to be done in a framework that can combat financial crime and also protect consumers at all times. And this is where, in a sense, we need a new type of stablecoins because we're raising the standards of how you design such a system. This relates to all the risk that I think we've heard since White Paper 1 and all the conversations with regulators. Again, for those of you interested in kind of an overview, the G7 stablecoin report, the FSB stablecoin group documents, or even the recent presidential working group materials provide really a roadmap of what kind of risk a system that is trying to kind of create a stablecoin and eventually interface this with consumers and merchant needs to address. I would place those risks in three broad categories. The first one is financial crime. The second one is consumer protection. And the last one is kind of governance of a stablecoin platform. Starting with financial crime, how are we addressing the risk that came out in those documents? Well, we're not going to support unhosted wallets in the initial phases of the project, namely because we do not believe we have a framework right now to support them, while at the same time mitigating the financial crime risk that they bring. Of course, we're investing R&D time and really trying to come up with good solutions to this challenge. Unhosted wallets could be the key to more access for unbanked and underbanked, so they can be really important for financial inclusion. But at this stage, again, by taking kind of a risk-based approach, we don't think it's the right choice for the network. And of course, we're hoping to work together with regulators in finding solutions on how to expand access to the payment system. When it comes to governance, I've already kind of discussed what are the key features here, inspired by open technology standards, ensuring a very diverse and distributed governance, and over time, really introducing market forces for all of the services that are critical to the network. But I'd like to spend most of the time here really on the risks related to consumer protection. I mean, these are particularly important when we think about something that would be used by retail consumers when paying for goods and services, or we're sending money home, for example, to their families. People will be relying on a network of this type. And so it's really important to raise the bar of what a stablecoin should be doing in this space. And part of this is really just borrowing from decades of learning in traditional financial services. So starting with the reserve is going to be composed, again, in the case of a Diem dollar, predominantly of US Treasuries of 90 days or less. These are HQLA, so high quality liquid assets. And on top of that, we worked through a number of stress scenarios to really ensure the capital requirements and buffers will be accounting for potential losses running from interest rate shocks to a run on the reserve and all of these aspects. Going through the Basel III framework was extremely helpful for us in really trying to quantify, again, one-to-one backing is just a starting point. What other risks are in the system, and how can you really mitigate them? So no fractionalization at the reserve is of course the starting point. But when you think about it, there's also risk at the VASP level, so a virtual asset service provider. It won't matter if we don't fractionalize the backing at the reserve, if then a VASP, think about a wallet or another operator, is able to introduce leverage in the system somewhere down the road. And so one of the requirements that we're bringing into the picture, which again, it's novel for a stablecoin, is that VASP will have to back 1-for-1 the Diem coin liabilities with Diem coins. And we have kind of a structure that ensures that consumers can turn to their VASP, convert their coins to fiat, and that VASP can kind of come up all the way to the reserve and receive fiat in exchange. I think there's tremendous amount of innovation happening in spaces like DeFi, decentralized finance. But when you think about payments, it's especially important to think about what kind of risk does leverage in the system through all sort of very complex smart contracts and financial assets introduce into a payment network. And since we're extremely focused on solving problems for consumers and merchants and businesses, leverage or fractionalization, even at the VASP level, could be problematic. Again, this is a system that is different than the traditional financial rails, but we do want to ensure that we meet and exceed the standards of consumer protection. And so one of the key differences, again, will be not only the quality of the assets, the additional capital requirements and buffers, and on top, the fact that VASP will be holding 1-for-1 these coins when they're taking custody of them with consumers. Now, on the last point of the public sector and how we can be helpful, I think in white paper 1, we really did not do a good job at communicating the intentions of the design. And I think part of the misunderstanding was that, Diem was perceived as something that was competing with fiat. But when you think about it, because of the one-to-one backing, even in the original design, Diem was building on fiat, was never meant to compete or displace, of course, the role of currency and the role of the public sector in macroprudential policy. We really see this project as a bridge between the existing rails and the new ones. I think there's a lot of potential in the new rails. They're faster, cheaper, more efficient. They can enable all sort of new applications. But at the same time, they don't bring right now the same type of protections that consumers and businesses have come to expect. And so, by having this dialogue with regulators, we really imported those features back into a digital asset-based system. So think of the reserve again as retrofitting a lot of those best practices and allowing you to move these Diem coins faster and in a novel way, and especially in an interoperable way between different types of participants. I think we do have all sort of digital balances today in digital wallets. It's very difficult for consumers to move them between different entities or even send them across different entities and countries. There's extremely rapid progress happening in the cryptocurrency space, as we probably witnessed even in the last few weeks. We think that a project like ours that is actively engaging with regulators, it's having a dialogue about which features of kind of the traditional rails are really important to preserve and which ones actually we can innovate on. Not only will allow a system that will preserve user privacy and allow a number of approaches around privacy to flourish, but also can port over the values that society has really given to all sort of critical infrastructure like the one that we use for payments. So from a public sector perspective, our view is that the public sector probably would be best served by essentially betting on multiple networks and encouraging multiple networks to emerge and compete with each other. In a sense, that retains optionality in a phase like in the early days of the internet. There's no such thing as a dominant design or a way to solve the problem of payments and financial services on digital assets. And I think there's a very big risk of picking winners or even trying to deploy a public sector solution that is the one that we're going to use for multiple decades. And so a more nimble approach with smaller experiments could probably lead to a bigger payoff. I will conclude by saying that often we don't think about the opportunity cost of not innovating and not letting some of these experiments flourish. Every time, a project like ours is kind of taking longer to go to market. You have two things that are happening. First of all, there's a number of consumers and businesses that are underserved, and of course this is particularly striking right now with the COVID crisis. There's a number of improvements that could be delivered essentially in a very short amount of time. But also you're seeing other systems emerge, and those really don't bring any of the protections of the current system. And so in a sense, you kind of have a race between different approaches. And we think that, again, the one we're taking, which is heavily engaging with regulators and trying to really think through what are the features that are important for consumer protection, for fighting financial crime, and for overall robust governance, are going to be really important for this to succeed. Thank you.
Thank you, Christian. We do have a number of questions coming in. So I do want to start on this one question, which we've had a few on, is how do you envision on-ramps onto Diem from third-party service providers? How will Diem exchange occur with other digital currencies? You've talked about interoperability, creating competition, lowering the cost, this kind of analogy with the internet. Anything you want to add to that?
Yes, I would say, so there's multiple aspects to that question. So the first one, which is, how can Diem be interoperable with any other asset that kind of presents the same type of protection or is going through the same type of regulated entities? The simple answer to that is, like, as long as you have an exchange or a VASP listing multiple assets, users will have an easy way to convert and move between these different networks. And to some extent, part of the beauty of blockchain technology is that all those interfaces can be automated and enhanced over time. So there's a degree of interoperability that's kind of really at the core of how the technology works. That said, I think the really important on and off ramp is the one with fiat. And that's where traditional banks and financial institutions, innovative players, including telcos and others, can really play a major role in ensuring that if the endpoint in a region, for example, is a mobile terminal, people can still come in and out from services that they're already using or from services that they're already familiar with, and then take advantage of the cheaper cost that they may experience on the network. That said, last mile frictions are a major hurdle for any new type of network, and so we think that we can drive the cost of cross-border remittance flows, for example, way down relative to the Sustainable Development Goal. I think that's about 3%. I think this is a network that can operate, at very low fees, but that will take some time. And in different regions, that will be really defined by the degree of competition. I think the more we can encourage competition, the more, as we've seen again in India with UPI, cost for consumers will come down, the experience will improve, and we can make payments almost instantaneous and free under many use cases.
Thank you. You mentioned the last mile problem. I have a question myself, is related to financial inclusion. A lot of this requires policy changes rather than novel tech solutions coming about. So for example, if there's a lack of formal ID or formal address, there's lack of financial literacy or education, how could Diem be effective in some of these markets if there isn't some of these prerequisites already there?
Yeah, and those are real frictions, right? So it's not that because we have a new type of network, those will disappear immediately. And in fact, when you look at the issue, for example, of unhosted wallets, the real critical friction is better ID. Regions that have improved identity standards, I think, are already seeing the benefits of that. It's very difficult to support payments at the retail level if you cannot do proper KYC and don't have the proper AML and CFT controls. So we see all of this working hand in hand, and we're also relying on the expertise, for example, of some of our social impact partners that have active engagement around identity and eKYC in a number of regions. So again, this will be work in progress, but by lifting and improving our identity standards over time, I think we will be able to make a dent also on those segments.
Thanks. Another question regarding national currencies and some of the developing markets. Many have suffered during the pandemic, and there has been some pressure on some of the fiat currencies. How does Diem affect some of these national currencies? We talk about, for example, dollarization in Cambodia, and the Bakong system is there to promote the national currency. Would Diem possibly undermine some of these strategies or have some impact on the national currencies themselves?
Yeah, so eye level, we take dollarization, but in general, the problem of currency substitution in a moment of crisis towards our currencies very seriously. That's kind of different than some of the stable coins that are operating today, where almost dollarization is sometimes seen as a feature. We think for the long-term success of the network, we do need to work really closely with the public sector in the different regions, especially in emerging countries. The goal is to, over time, work with the public sector and enable more and more of these single currency stablecoins, so that there's a natural way to address the currency substitution risk. That said, you could imagine, because the network is digital and all the participants on Diem will be regulated VASP, so virtual asset service providers in the region. Insofar as a local government, for example, is worried about currency substitution, they could impose a maximum balance limit, so that user, for example, could still receive a remittance from abroad, but then may have to convert it back into local fiat, avoiding, again, the use of this as a saving vehicle.
Thank you. Maybe you can just tell us about the overall market infrastructure changing as a result of Diem going live. So it's one piece of many changes, like the RTGS renewal programs, FedNow, some more novel payment system upgrades we're seeing, even in cross-border payments, say Ripple or Swift GPI changing. So how does Diem kind of position itself in, say, nationally and for cross-border payments?
I would say that, first of all of these improvements, especially the ones on the public sector side, are extremely beneficial. In a sense, they make a network like Diem more useful, because there will be more ways that you can come on and off and use some of the Diem features. In general, I think there's a broader push towards more efficient, cheaper payments. I think there's a number of challenges when it comes, especially to cross-border, related to harmonization. I think the FSB stablecoin group has done really fantastic work in trying to drive an agenda towards harmonization of laws and regulations. What will have to be seen is essentially how much will that translate into each jurisdiction. We think that for this to be successful, and all these efforts to really make a dent on, for example, the cost of cross-border, we will need more uniform rules, so that a payment network in one region can really communicate and interoperate with one in another region. But in general, I think what's really interesting to see is that, again, from a public sector perspective, you have a number of experiments, you have a number of networks. They will have different features and different trade-offs, and then consumers and merchants will be able to choose and kind of drive innovation and competition across them.
I have another question, more suited around the technology. So it's why bother with DLT altogether, with it being such a closed system, permissioned payment system? I know that you just explained it's now going to be permissionless. What is the benefit to DLT blockchain? Do we meet some of the throughput, the resiliency, the security requirements a payment system needs?
Yeah, so let me clarify. So the system will not be permissionless. What we're doing is we're starting with a permission framework, and then introducing in some of the best design feature from an economic perspective of permissionless network. But in a sense, we're innovating in this area too. I think the use of DLT is still extremely important, and part of it is also the upside in the long run. As you enable new types of use cases, think about programmability. We have a programming language called Move, and over time, we see a lot of potential in expanding use cases, many of which also relate to financial inclusion on that layer. That does require distributed governance. That does require kind of the ability to not having to trust a single entity, even if it's kind of the operator of the network. And so while it may seem to some extent overkill, the degree of distributed validation and governance that we have at the start, we think that that's where a lot of the long-term potential and innovative potential of the network will be. To answer your point about, how does this compare to traditional payment network, DLT-based systems like BFT are actually extremely resilient and really designed to operate in the most adversarial environments. Again, the threshold of being able to lose about a third of the entire network and still keep operating, it's a very high bar relative to any system that is currently in place. And we think that, again, the use of cryptography for a number of the features that are used will really improve on the standards, even for payment systems.
Thank you. A question about the fungibility. How advanced is the Diem association to ensure that Diem will be accepted at the point of sale, or it's convertible with local banks as well?
Like any new system, we're extremely focused right now in working with our membership in ensuring that there will be simple on and off ramps at the beginning, right? People will want to be able to come in and out very frequently. But over time, I think when you think about that issue, the key is really in enabling use cases that people find valuable. So that starts with P2P, which is probably the simplest one to support, and P2P with cross-border. It follows with P2M, so payments to merchants, and ensuring that payment service providers can now support Diem as an additional payment vehicle.
Thank you, Christian. I think we have time for one more question. This one's more looking at the transaction fees. So on blockchains like Ethereum, transactions transferring stablecoins need to be paid in Ethereum. What's the model like for Diem?
Yes, so this is where again we're different. We do have gas in the system, but gas plays a minimal role. It might be used for prioritizing transaction, but we expect the cost of gas to be close to zero. And in general, because of the different infrastructure, again, we don't need like mining to protect the perimeter. We will be able to support transaction fees that are orders of magnitude smaller than current systems that rely, for example, on mining.
Thank you, Christian. It looks like we're past our 45 minutes. Thank you to all our attendees listening today. Do visit OMFIF's Digital Monetary Institute for updates on our upcoming meetings and our research. And for those who are registered for the invitation-only session with Christian, we'll take a short break and we'll see you again in about 10 minutes. Thank you.
Thank you so much.